Hi, I'm Nick Mersch, a portfolio manager here at Purpose. Today, I'm excited to talk to you about yield shares, the world's first yield-focused single stock ETFs. We designed yield shares to offer investors an important tool to manage and customize their exposure to individual stocks. With yield shares, investors can earn attractive yield while holding the stocks they love, like Apple and Tesla. In this video, I'll tell you how yield shares work and how you can use them to customize your portfolio. Yield shares by Purpose are ETFs that are designed to provide exposure to the long-term return profile of an individual stock while maximizing monthly yield from that name. By introducing a mix of covered call writing strategy and moderate leverage, the performance of the product closely mimics the performance of the underlying while providing yield. So how do yield shares work? Each individual stock yield share has three components. The first thing involved is the outright purchase of the shares of the underlying stock. Next, we add a modest 25% leverage to purchase more of that specific underlying security. Lastly, we implement a covered call writing strategy on 50% of the exposure with call options between at-the-money and 5% out-of-the-money calls. This strategy utilizes the combination of moderate leverage while writing partial calls in order to maintain exposure to the long-term performance of the underlying stock while providing attractive yield. In addition to yield generation, the product is designed to have several other attractive features, such as a proprietary option strategy. In this strategy, we use a tier of options with different expiries and different moneyness in order to de-risk critical one-time events, such as Fed meetings, earnings periods, and particularly important now, CPI print days. By laddering maturities, we are able to insulate the product from an over-reliance on path dependency. Another feature is the efficient tax treatment. The yield generated from the covered call strategy is recognized as capital gains instead of income. The third feature is currency risk. For US stocks, all US exposure is hedged back to the Canadian dollar, providing an effortless way to buy US securities without the additional currency risk. Combining several of these features into one simple and easy-to-use product makes yield shares by Purpose a great complement to single security positions. We view yield shares as a tool that can complement an investor's portfolio. Any investor having single stock exposure can benefit from combining all or a portion of their holdings in a single security to yield share. This will provide the investor with an attractive yield on single stocks that don't traditionally pay dividends. In addition, investors can now receive monthly distributions rather than on a quarterly basis. By nature of the combination between moderate leverage of 25% and only 50% coverage on covered call writing, this strategy also provides exposure to returns on the upside and downside similar to the underlying security versus using only a covered call strategy. Where this product performs best on a relative advantage is in periods of high volatility in sideways markets by generating higher premium on the written call options. Performance in various markets broadly mimic the return of the underlying stock while generating yield, but the volatility of the underlying security will create variances around over or underperformance. To conceptualize this, we will use a 3x3 matrix. We will walk through a bull, sideways, and bear case in a high, moderate, and low volatility environment. In a low volatility environment, the impact of leverage is 1.25 times the price action of the underlying, the yield you are generating from the option premium is lower, and you'll be getting called in less frequently. This leads to overperformance in a bull market as the leverage impact typically exceeds the impact of getting called in. In a sideways market, you will outperform from yield pickup, and in a down market, the impact of leverage exceeds the premium from writing the call, leading to underperformance. In moderate volatility, the impact of leverage is 1.25 times the price action of the underlying. You get called in more frequently, but you also generate higher yield premiums. This leads to market performance in bull and bear scenarios as the impact of leverage, getting called in, and the option premium will generally offset. You will strongly outperform in sideways markets by collecting more premium. In a high volatility market, the impact of leverage is again 1.25 times the price action of the underlying. The option premium is very high, and you get called in more frequently. This leads to underperformance in strong bull markets as you get called in quite frequently, capping the upside. You will very strongly outperform in a sideways market as you're capturing more yield from higher volatility, and you will outperform in a bear market as the option premium impact will be greater than the leverage component. We believe this strategy can provide very attractive total return profiles and performs best in a highly volatile sideways market. Thanks for watching. To learn more about Purpose Yield Shares, please visit our website or reach out to our team directly.